Good afternoon, everybody, and thank you for joining our webcam this afternoon. Where are we now is a really good question. On December 27th, 2020, President Trump finally signed the stimulus package, which resulted in a lot of changes in tax law and created a PPP loan number 2 program. Today, we hope to cover a lot of the items. I'd like to first make sure everybody knows this is a 5,000-page bill that was signed. It's taken a lot of time to summarize and create what we felt was important for today's presentation. We'll be asking a number of polling questions throughout the webinar to gauge our audience. Please submit any questions through the questions box on your control panel. We will answer each question after the conclusion of the session, and a full Q&A document will be sent to you along with a copy of this presentation and a link to the recording. The presentation is not intended as tax advice, and the information presented is subject to change as guidance is released. Attendees are encouraged to discuss their specific situations with their tax advisor. The highlights of the key COVID-19 related relief of nearly $900 billion was signed into law, as I said, on December 27th, 2020, as part of the Consolidated Appropriations Act 2021 HR 133. It includes, which we will go over today, stimulus payments for individuals, additions to unemployment benefits, the deductibility of expenses paid with PPP or Paycheck Protection Program loans that are eligible for loan forgiveness, the new PPP loan opportunities, and numerous other tax-related changes. The first polling question . The poll is open, and basically you can answer the question, and we're going to let you just answer it for a few seconds. We have a lot to cover today. Okay, the poll is closed. We're going to go on to the stimulus payments for individuals. This is the second round, okay? Eligible individuals will automatically receive up to $600 for this refundable tax credit. The IRS and the Treasury have begun issuing these payments. If you haven't got it or you want to check on your payment, you can use IRS Get to My Payment tool to check on both the initial payment and the second payment. Married couples filing joint tax returns will receive a maximum of $1,200. Additional $600 per qualifying child will be paid through the stimulus benefit, and payments are treated as an advanced rebate of a 2020 tax credit. There's a phase-out range that begins based on 2019's adjusted gross income, your AGI. For single people, $75,000. For head of household, $112,500. And for married filing jointly, $150,000. The initial stimulus checks, the economic impact payments, EIPs, were made available in 2020. There were a tax credit paid in advance to qualified taxpayers based on 2019 or 2018 income based on the return you had filed at the time. And $1,200 was sent for singles, $2,400 for married filing jointly, plus $500 per qualifying child. individuals will receive notice 1444 in the mail regarding your EIP payments. If either a first or second stimulus payment was not received or was less than fully eligible based on 2020 income, then taxpayers are entitled to a recovery rebate credit. Note, the taxpayers may request this is 2021 when filing 2020 Form 1040 or 1040 SR. In addition, the bill provided for additional federal unemployment benefits. So the federal pandemic unemployment compensation, FPUC benefits extended through March 14th, 2021. And there are an additional $300 of supplement weekly payments. The pandemic unemployment assistance, the PUA, is for part-time, freelance, and self-employed workers not qualified for SUI benefits. This was extended 11 weeks, and the applicants must provide proof of previous employment or self-employment within 3 weeks of applying. And if approved by PUA by March 14th, benefits can continue for another 4 weeks. Pandemic emergency unemployment compensation is for workers who have exhausted state benefits. These benefits are extended through March 14th, 2021. If approved for PUC by March 14th, you can continue receiving benefits for an additional 4 weeks. Mixed earner unemployment compensation for those earners with mixed self-employment and W-2 employment income may qualify for an additional $100 in addition to the FPUC of $300 if they had 5,000 or more of qualifying annual self-employment income that they lost. This benefit is also through March 14th, 2021. Now we'll put out there polling question number 2. And we'll leave this open for a few seconds. The questions will get harder, so pay attention as we go beyond polling question 2. Okay, so the polling question has been ended, and now I'd like to turn the program over to Ed. I'm sorry.
Actually, Robbin.
Robbin, who will continue.
Hi, Robbin Caruso. Good afternoon, everybody. Interestingly enough, we asked that last polling question because we wanted to make you aware that even though you may have received your first round through one of those means by direct deposit or debit card or in the mail, your second payment may come differently. They're not necessarily linked, and as Bob said, they've already started, so start watching out for those. These will come automatically. As you may know, the CARES Act, when it came out, had made a number of important modifications to charitable contributions that enable us to be more generous. So, for instance, going from 60% up to 100% of your AGI, not too many people can do such, but that's extended into 2021, as is the charitable contribution increase for corporations. But we also have an increase. Last year, they not only extended the 2020 provision, they increased it for the $300 above the line deduction. And above the line deduction means you don't need to itemize. So even if you're taking the standard deduction that you're entitled to, you could still deduct up to $300 for single filers, and now married filing joint filers for 2021 only get $600. And an important point for everybody is that in this new act, and this was not there before, this is new, penalties for underpayments of taxes attributable to an overstated deduction have been increased from 20% up to 50%. So be careful. You don't want to be overstating your deductions. Flex spending accounts. These have gotten more flexible. The act has made what we all think of as the use it or lose it, or we could roll over a little bit and have to use it by March. They've extended the grace periods out so that we have all the way through 2021 to use our monies from 2020, and again from 21 into 22. And the other really important thing is that normally dependent care benefits weren't carried over, and they're allowing the dependent care FSAs to be also carried over. In addition to, they increase the threshold for the age limit of how these monies can be used. So your employer will be able to reimburse you temporarily for FSAs for dependent care as long as the child's under 14 now, not 13. And then we all make our decision, what do we want to put into our FSA funds at the beginning of the year, but things have changed and the pandemic has affected us such that we may want to do things differently. So they've offered the opportunity to permit companies and businesses to do a mid-year open enrollment should they choose to do so, to enable you to go backwards with that, and you'll be able to take advantage of that. Another huge win that happened is with medical expenses. A lot of us remember that the threshold used to always be 7.5%, and when the Tax Cuts and Jobs Act came out, it started shifting towards 10%, and it's gone up and down and extended and moved, but now they have permanently set this back at 7.5%. So that's a terrific win for those who itemize and anybody with medical conditions, seniors, etc. So that's great. And while the housing market has obviously settled in a bit, so our prices are back up where they used to be, there are still people who have problems and are finding themselves in foreclosure situations due to the pandemic, loss of jobs, things like that. So if for any reason you find yourself where you end up with a mortgage debt forgiveness, that's like the cancellation of debt that people might see. Normally cancellation of debt is taxable to you. This will remain tax exempt for the next 5 years. So that's another terrific win. And now I believe we have another polling question.
The poll is open.
A little more aid and stimulus on the other side, so we've been in the immediate reaction to COVID than what we've gotten so far, and the stronger we got, hopefully it's the community, which is now becoming a bigger challenge given the slow rollout of program.
Also, let me try to get your reactions to the minutes. I mean, the Senate, the change in the Senate, it was like the Senate being pretty blue, not color blue, it looks to be what the markets are doing. Because the market seems to like the idea.
The poll is closed, and I'd like to turn the program over to Ed Rigby, and he will bring us up to date on the changes that are in the Paycheck Protection Program.
Well, thank you, Bob, and good afternoon, everybody. For the audience out there, I'm a tax partner in Prager Metis, normally in normal times based in the firm's Cranberry office. But you may have read or heard in the media about the size of this bill, which is a big appropriations act. You heard about 5,000 pages, and I kind of chuckled last night, Rob, and when we were going through some of the provisions, and with 5,000 pages, I would say, go to page 4,064 and look at this section. So it's a major, major act. $900 billion of COVID relief, about a third of it, $284 billion for the Paycheck Protection Program. And just to start with a perspective, I mean, I'm assuming most of the audience has heard by now about the Paycheck Protection or PPP program. I mean, during this, when it came out in the CARES Act, late March to the spring and summer, I was on many calls with business owners who were really struggling. And, you know, in my local town, you know, we know my wife and I know many of the business owners by name, and they said, you know, if I brought up the PPP loan, they said, you know, that really, really helped us. And I also have to say, our fellow colleagues at Prager Metis throughout the firm, I mean, you know, we fielded so many very thoughtful, passionate, and energized questions as our colleagues were looking to help their clients out with this program and understand all the nuances to it. So we go 100 miles an hour every day answering questions about it still. The PPP loan, I'm going to start with a little bit of an overview of the history of it and some of the key aspects of it. And Robin, feel free to jump in, or Bob with your perspectives as well. But essentially, the original PPP program, the key issue there was qualifying for tax-free loan forgiveness. So the CARES Act said, if you meet certain criteria, your loan will be forgiven in a tax-free manner. Normally for tax purposes, when we have a write-off of a loan, it triggers taxable cancellation of debt. So the CARES Act said that the write-off of the loan, and if it qualified for forgiveness, it would be tax-free income to the borrower. Silent, though, on the issue of deduction of the associated expenses, and we'll get to that. And I think a lot of people are waiting to hear some good news from Congress in this bill. But the loans before June 5th, and June 5th was a key date. This was the Paycheck, the PPP Flexibility Act. And, you know, we talked to many borrowers and colleagues, and they said, you know, our client or our business, the original PPP loan allowed you to spend the money for payroll and other non-payroll eligible costs over an 8-week period. But the problem is, with the shutdowns during that time, most of the people were spending through the money, and, you know, looking on the horizon, you know, they were concerned about being able to reopen. So Congress wisely on June 5th, and the president signed into law the Flexibility Act. And it shifted that 8-week covered period to 24 weeks. And I think that was a really, really big help. It allowed the borrowers to spend more on payroll costs. But, you know, the original loan amounts were $10 million. If you didn't qualify for loan forgiveness, at worst, you'd have a 1% interest loan, non-recourse, non-security loan that could be paid off over 5 years. If it was pre-June 5th, it would be a 2-year payment period, but you can negotiate that with the bank typically and do the 5 years. But at worst, you'd have a low interest rate loan. But the whole game here was to qualify for loan forgiveness. So the original PPP program required, there was a tweak in the June 5th legislation that said you have to spend at least 60% of the loan money on eligible payroll costs. So that could include benefits for non-owners. There were certain rules there for owner compensation, and also eligible non-payroll costs such as rent, interest on mortgages, certain utilities. But, you know, in perspective, a lot of this, you know, there was so many questions as we rolled out from the CARES Act, and as we waited anxiously for SBA guidance along the way, which is sometimes a little bit slow coming, or sometimes when SBA and Treasury issued regulations, Robin and Bob, you can relate to this, it would trigger, for each question they answered, it would trigger another 10 questions based on their guidance. So that's why I say 100 miles an hour every day answering questions on the nuances. So, you know, one of the key things was who could qualify for the PPP loans. And, you know, we had to roll our sleeves up and become experts on many aspects of the SBA rules. So we were originally told that the businesses, this was limited to businesses with 500 employees. There was special rules for the hospitality industry. So if you were a hotel or a restaurant, you could base that $500 limit on per location. But then there was other nuances to it. So, you know, we had to look at, you know, the revenue, how much a gross receipt standard based on different industries. You could be a law practice and have a certain revenue threshold. You could be a manufacturing company and have a certain revenue threshold. And then also there was the alternative size standards that are still in place. So you'd have to look, there's a tangible net worth of $15 million and also a net income before taxes of average net income before taxes of $5 million. So we had to look at all of these different size standards and advise our clients, as to whether or not the borrower was eligible as an SBA, for an SBA loan. Also for nonprofits, we have a lot of clients that are nonprofits. This was limited to 501c3 organizations. There was certain veterans organizations. But now we saw with the COVID relief bill and HR 133, as we go to the next slide, we're going to see some additional eligibility. One of the things, when I first read the CARES Act, and I mentioned earlier that the intention of Congress was to create a forgivable loan program. Robbin, we did some webinars with the New Jersey Business and Industry Association, and we had one of the district directors on, and talking to him before the call, like he said, well, don't call it a grant. I was saying, this is like a grant from Congress. He said, don't call it that. It's a loan and it's a forgivable loan. And so Congress intended the forgiveness to qualify for tax exempt treatment. But then back in April, the IRS, my original thought was that, the expenses that are paid, the payroll and non-payroll expenses, are absolutely going to be deductible by the business owner. And I saw no reason why it wouldn't, although the language in the CARES Act was silent on it. So surprise, in April, the IRS popped up and they said through notice 2020-32, they said, well, because this is associated with tax exempt income, we're not going to allow you to deduct the expenses. And everybody said, whoa, can you believe it? So, at that time, my thoughts are I was always kind of cautiously optimistic that Treasury or Congress would come to their senses and provide some relief here. In November, the IRS issued Revenue Ruling 2020-27, and it said that if you reasonably anticipate that you're going to qualify for loan forgiveness, even if that application is going to be submitted beyond the end of the 2020 tax year, you're still going to have to treat those expenses that were paid in 2020 as non-deductible expenses. You'll see a note here, just hot off the presses, and it shows how timely we are with this. The IRS just issued Revenue Ruling 2021-2, and it declared the two rulings previous, Notice 2020-32 and Revenue Ruling 2020-27, as obsolete, so not applicable. So if we go to the next slide here, going back to when the IRS issued their notice in the spring, this shocked us. So, when we had to face a world of monies that were spent with funds that qualified for loan forgiveness, and these expenses would be non-deductible, all the different tax issues that were associated with that non-deductibility all came into play. Our firm does an awful lot with software developers, manufacturers, with research tax credits that give business owners terrific tax benefits for their investment in research and development. There's also in the 2017 Tax Cuts and Jobs Act a new deduction for pass-through business owners and sole proprietors called the 199A deduction or QBI deduction. So the impact on these two major tax benefits was profound. R&D credits, the assumption would be the expenses that are paid for wages for people that are doing experimentation work that would qualify for R&D, those expenses would have to be deductible. If they were non-deductible, it took the credit off the table. The 199A deduction has a W-2 wage cap for taxpayers above a certain amount of taxable income. And that W-2 wage cap is based on the assumption that those W-2 wages are deductible. So that could further limit the 199A. So it forced us to sort of, I like the word pivot. So we had to kind of pivot in our applying for loan forgiveness and helping clients, that if we were trying to protect the R&D credit, if we were trying to protect the 199A deduction, to load up certain non-payroll expenses into the application. Because remember, I said earlier, you have to pay 60% of the loan for payroll, 40% for certain non-payroll expenses. So, by taking some of those, the forgiveness and sliding it to non-payroll costs, that would help possibly protect these other tax benefits. So now that we have Congress stepping in and saying that the bill clarifies that the amount of tax-free loan forgiveness is going to be treated as tax-exempt income, but the expenses would be deductible off of that. So now with tax-exempt income, if you operate a business in the form of an S corporation or a partnership, the basis adjustment rules are very important. Just in general, in order to deduct losses or to determine the tax treatment of distributions, you have to calculate your basis in the respective entities. So for both partnerships and S corporations, tax-exempt income results in a basis increase for the owner. And so that basis increase will help absorb losses that would be associated with the deductions that are paid with PPP money. Now, there's been some thought, some questions. There's been some articles out about the timing of when does the tax-exempt income actually impact the equity in either the S corp or the partnership interest. And generally speaking, maybe for financial statement reporting, the question is, does the income get recognized? Does the tax-exempt income, does it get recognized when SBA says your loan is forgiven and they reimburse the SBA lender for the forgiveness amount? So that could carry into 2021 when the expenses were actually paid in 2020. So this is an issue of timing. I mean, my personal, again, I use the word cautiously optimistic. The wording of the act says that the basis will not be limited, deductions will not be limited, or any attributes of the borrower will not be limited because of tax-exempt loan forgiveness. So I'm hoping that there's clarity that the basis increase for the tax-exempt income and the deductions will both be taken in the 2020 tax year, or with the new round of borrowing, as long as it's in the same tax year. So again, I think that's very favorable. And I'm going to just add a note. I mean, as a tax partner, Robbin, you can relate to this, and our colleagues out there. In the CARES Act, there was major benefits for the COVID crisis, net operating losses. So if you deduct these expenses paid with PPP money, and those deductions help you create a net operating loss, you can carry that net operating loss back 5 years and claim refunds on prior years. When you think about it, if you're a corporation, if you're a C corporation, the rates before 2018 were up to 35%. Starting in 18 going forward, 21%. So you'd be carrying losses back to even higher tax rates. For pass-through entity owners, one thing to keep in mind, there was a rule, excess business losses put in by the Tax Cuts and Jobs Act. And so these excess business losses limited the losses on the taxpayer's return to $500,000 if you're a married joint filer. The CARES Act modified that rule and said for tax years 18, 19, and 20, that rule does not apply. So if you're generating losses in 2020 paid with PPP money, you're going to be able to possibly create a net operating loss. So I think that's very important to point out. All right, so let's talk about the new round of PPP loans. So the first round expired August 8th of 2020. And there may have been some qualified borrowers that did not benefit from a PPP loan. So this new round of loans are going to be available through March 31st, 2021, so the first quarter of 2021. And again, SBA has 10 days from the date of enactment December 27th to issue guidance, so that might come out tomorrow, and we're going to be looking for that. Now, the one, Robin, we were looking last evening at the existing loans, so people that are first-time borrower, and you know the act is somewhat confusing, but we based on the statute, the first-time borrowers can still borrow up to $10 million. And the limit on employees is the 500 employees. Special rules for hospitality if you have more than one location. But again, we also apply these other size standards I mentioned, you know, based on gross receipts or alternative size standards. Now, if a business previously received a PPP loan, they could qualify. So that question came up a lot. I borrowed money, I still need help. We can't completely open, or our revenues are down. We need help. Can we borrow again? Well, that's what this bill is going to open the door, and they're called second draw loans. So these second draw loans, they're capped at $2 million, and there's certain criteria. So the business has to have 300 or fewer employees. There's, again, alternative size standards that have to be looked at, so you could otherwise apply. There's also rules of affiliation. So if you're a restaurant or a hotel, you can look, as long as you have no more than 300 employees at each location, you could still qualify. You'd have to demonstrate that you have used or you will be using up all of your initial PPP loan. And then this is a new criteria here for these second draw loans. You have to demonstrate that the borrower suffered a 25% gross revenue decline in 2020 as compared to a same quarter in 2019. So people that have asked, well, what if my client, or what if my business, what if I started the business after the end of 2019? Well, one thing I want to point out is, to be very clear, the business, the borrower must have been in business before February 15th, 2020. Ed, what happens if I started my business last April? No, you can't borrow off the PPP program. You have to be in business on or before February 15th. So if you weren't in business in 2019 for this 25% gross revenue decline test, you would look at the you'd look at your fourth quarter of 2020 and then compare it to the first quarter. And if you had a 25% decline, you'd be able to qualify. Also opening up the door, we have clients that are chambers, business here across the firm, 501c6s. Got that question a lot. Remember I said earlier, you were limited. Borrowers had to be a 501c3 or certain other organizations. So now C6 organizations, so a Chamber of Commerce, the National Football League legal office specifically, they cannot borrow. So certain business leagues cannot borrow according to the statute, but your Chamber of Commerce may be able to borrow there. So we still have the 60%. I'm sorry, Robin, go ahead.
Sorry, I think I read something about the football leagues. It's if they're connected to lobbying or other things that preclude them potentially.
I thought that they were struck out. Yeah. I thought that they were out of there as a eligible borrower. Remember, they had an issue with the Los Angeles basketball team too, that created a little bit of an embarrassment with the program. But I could be wrong. We could certainly look at that. So the second round of funding, we still have that 60% of loan proceeds. So the 60% of the loan has to be used for eligible payroll costs. There's also an opening for other non-payroll costs. Remember I said earlier that we were limited to rent, utilities, certain other expenses. But now the bill opens up the door, and this would also apply if you haven't if you haven't received loan forgiveness and you're still on your first go round of PPP money. These other non-payroll costs would be allowed. So if you have to purchase worker protection equipment or any facility modifications to comply with COVID-related government safety guidelines, computer software, accounting needs, cloud-based services would also be available. payments if you have essential suppliers. I heard that a lot. We need the money to help pay our independent contractors or pay for these service providers that are crucial to our business. We have entertainment clients. We're talking about production companies and being able to maintain these key persons. I heard that across the board. Well, we were very limited. The payment had to be for your employees, not your independent contractors. They would borrow on their own. But essential suppliers, so if you have a vendor that supplies goods to your business that, you know, let's say a supplier that supplies raw materials that go into your manufacturing process, yes, you can include those essential suppliers for goods. Here's a twist. We looked long and hard over the time when CARES Act first came out as to what qualifies for payroll costs, and there were certain benefits, health insurance benefits. Now, the Act clarifies that you could also look at other types of insurance, group life insurance, disability, dental, and vision. I said earlier about the 8-week and 24-week. So if you borrowed your money before June 5th, you were using 8 weeks, you could elect then to go with 24-week covered period. And that simply means that from the date you get the loan, and there's some nuances depending on the first payroll there, but the date you get the loan proceeds, the clock starts ticking, and you have 24 weeks, which SBA says is 168 days to spend the money out. If you have reductions in your full-time equivalency, so employees, you reduced your salaries by more than 25%. You would suffer a reduction in the loan forgiveness based on complicated rules. But you were able to restore those reductions, restore FTEs. Yes.
I think it's important to just re-emphasize that they've added the computer software, accounting needs, and including cloud-based services, because these are expenses that maybe had been overlooked, but definitely would be putting people into the 100% forgiveness category.
Yep, so, I thought he had mentioned that. Yeah, absolutely, Bob, you're right. And also too, it's important to point out that even if you haven't submitted an application, if you're on your first PPP loan from the original PPP program, you could still count those expenses. So even those expenses would help you get to that 100% loan forgiveness. Now, the size of the loan. So people that are going for a second drawer, then the amount of the loan would be based on 2.5 times the average monthly payroll costs, looking back to the previous year, or you can elect to apply the 2019 calendar year. Special rules for the hospitality industry. So if you're a restaurant, you're a hotel, you can take a loan out up to 3.5 times the average monthly payroll costs. Now, there's a cap. So this is based on the first go round also with PPP. The amount of cash compensation was limited to $100,000 annually, and then you would prorate that amount. So if you were looking at an average monthly, you would take your, divide it by 12 times 2.5, and that's how much the business can borrow. For certain non-owners, you can add in, group health insurance benefits, and on top of that, hospitality 3.5 times the average monthly payroll costs. We're excited about simplification, and before this act came out, loans up to $50,000, so very small loans. There was a simplified form 3508S, which is basically you're just certifying that you've spent the money on the eligible payroll costs, and even if you had a reduction in full-time equivalency, or if you had a reduction in salaries for your employees, you could still qualify. The SBA considered that to be de minimis, so the threshold is up. So if you're going to request a $150,000 loan or less, this would be issued by the SBA. They have, I believe, 24 days to come back with the applicable form, but it would be a certification that says that you meet the revenue reduction requirements, that 25% I mentioned earlier for second draw loans. Also for loan forgiveness, there would be possibly an additional form, whether the one and the same. Robin, you think that this might be, mutually, different forms, but when you apply for forgiveness, if your loan is $150,000 or less, again, a one-page certification that used the proceeds to cover applicable payroll costs, your number of employees that you were able to retain. I didn't see anything. Remember, a big thing, and now with loans over $2 million, there's a questionnaire that the borrower has to fill out, showing that, you needed this money for larger loans. And both for-profit and nonprofit entities have to fill this out. And it gets into, your decline in gross receipts. It starts asking these questions. Remember, if anybody, a business owner on the line here, or if you're a colleague helping the clients in the application process, it asked, it's a certification. It says, I certify that because of economic uncertainty, this loan was necessary to get me through the COVID crisis. I don't see where that, I'm assuming that on the second draw loans, whether or not there's that criteria that'll be in the application. Again, we will have to see. Record retainment, so your employer, go ahead, Bob.
I think it's important, though, for everybody to keep in mind that, nothing is automatic, and the forgiveness up to 150, which before was 50, it's very important to make sure that every client and everybody who files for forgiveness has met the 60/40, as well as anything else that they're going to attest to on the form. There may only be 4 questions, and you only have to initial them, but at the end of the day, the penalties are extremely severe for not having it. The other part is the record retention. At any time within 4 years, they could request it, and other supporters retained for 3 years. So I think it's important that the exercise is done by the client or anybody applying for forgiveness to make sure that they meet the 60/40 and the other expenses that qualify. So I think we should just keep that in mind.
And I just wanted to quickly add, before we do the poll, the previous slide, I mentioned about restoration of FTEs. So if you have a reduction in full-time equivalency, or you have a reduction in salaries by more than 25%, the first round of PPP allowed the borrower to restore those by the end of the covered period, or the end of December. Being that loans can go, this second round can go out to March 31st, 2021, you have to the end of the covered period to restore any reductions. So if you, again, a 24-week time period, if you had any reduction, you'd be able to restore those reductions by the end of September.
Okay, so we are up to polling question number 4. Will you be applying for PP loan forgiveness? And the poll is open. Okay, the poll is closed, and I'm going to ask Robin to pick up on the loans and modifications.
Hi. At the end of the presentation, Bob's going to talk a little more about next steps, but one of those next steps to keep in mind, just like with round 1, everyone got very worried about the money running out. Even though we can apply for these through March 31st, it's March 31st or until the funds run out. So I would strongly advise that people start putting together their packages to apply for this loan as soon as the guidance comes out as to what we need to do, so that you're ready. A couple other things I'd like to add. I do believe that when you file this application, you will be again certifying that you need these funds. And then the SBA has indicated that borrowers that have already received forgiveness in round 1, you may have already filed for that, and then they've changed the rules a little bit. So we do expect that there may be further guidance coming out. What do you do if you've applied for forgiveness based on the allowable expenses that were there previously, and that has changed a little bit? And the last thing I'd like to add on our prior topic is bankruptcies. It's another big change. Borrowers that are in bankruptcy are now eligible to apply for the PPP loans. So that's another important change, because I've had a lot of clients calling me up and saying, I have problems with my credit score, I may be in bankruptcy. So they've made that clear that they're doing that. And if this should happen and you end up in bankruptcy, they're going to treat the forgiveness amount as part of your Chapter 11 case somehow. But that's not my area of expertise, but I thought it was important to add. There were a lot of loan modifications to the treatment of SBA, the economic injury disaster loans. That's what we're all calling the EIDLs. EIDLs had very similar requirements. It was like if you were under 500 people and all those things, but they had a broader uses. You could use them for more of your operating expenses, but the monies won't be forgiven the same way. So if you borrow a standard EIDL loan, you have preferential loan rates and things like that, but it won't be forgiven. This new act has come out and we have tremendous results with it, because everybody was saying, like Ed mentioned earlier, we were told, let's not call these grants. They were calling these advanced payments advanced grants. And normally when you get a grant and it becomes not taxable income to you, which is what they did with that initial 1,000 per person up to 10,000. And you may recall when they first came out, they said the EIDL loans will be available up to $2 million, and that got scaled back to 150,000. And they said, and within 3 days, you'll get this $10,000 forgiven grant piece of money, and that changed into it'll be 1,000 per employee up to 10,000. And that was just because there was something like people asked for $400 billion or $1 million, where there was just a fraction of that available. So they reduced it tremendously. Now this new bill clarifies that these loan proceeds that are to be forgiven. So if you got that $10,000 grant, you don't pay for it, and you will not have to pick it up as taxable income. So it's forgiven, it's tax-free income. And on top of that, they had said that to the extent you received these advanced grant monies, you had to reduce the amount of money you were allowed to be forgiven on your PPP borrowing. That's gone away too. So you could get the full forgiveness of your PPP loan money that was used appropriately and qualifyingly, and also be forgiven on these advances. And to top it all off, not only excuse me, are we allowed to take the expenses as deductions, that we'll get to deduct these money. So we don't have to pick it up as income. We'll get to deduct the expenses that we use this $10,000 grant money to pay for. And similar to the PPP, like Ed spoke to, you'll get your tax, it's treated like taxable interest. So you'll get your adjustments to basis, and you do not have to reduce your tax attributes for these exclusions from gross income. So those are tremendous results.
Robin, I also think that if you have applied for forgiveness and you had your forgiveness reduced by the 10,000, it's going to be automatic, supposedly, that they will refund you or give you the 10,000 that was reduced. So
yeah, that's what I haven't heard yet, how they're going to handle that. What Ed's talking about is if you already applied for your forgiveness and you already reduced your forgiveness by this 10,000, what do you do? That guidance is coming out, but I expect it will be automatic, and so we'll see what happens with that. And then I think we had one more slide. The deadline to apply for the EIDL loans of up to $2 million has been extended out to December 31st of this year, 2021. But keep in mind, again, this is pending available funding. They have made $20 billion available, but this is for targeted EIDL advanced grants. So they're specifically targeting people that have 300 or fewer employees, are in low-income communities, have had an economic loss of more than 30%, and some other criteria. And then again, to reiterate, I put on here a few points that these are still favorable loans. They're not 1%, they're not fully forgiven, but it is a 3.75% interest loan, or 2.75 if you're not for profit. And these loans do have broader uses. So it's anything that's working capital or your normal operating expenses these can be used for. So that's another big benefit to the EIDL over other expenses. Some people can't pay payroll right now. They have other things going on, but they're trying to keep their business floating. So an EIDL loan in that case might be a great opportunity for you. Ed?
Okay, thank you, Robin. The next section of our presentation deals with an extension of the CARES Act, the Employee Retention Tax Credit. And you know, this certainly did come up when CARES Act came out, but there was one very important distinction. If you borrowed money through the PPP program, you were precluded from claiming the Employee Retention Tax Credit. So that dropped a lot of people, you know, out of the discussion on this very significant tax credit. But larger businesses that weren't eligible, that didn't meet the size standards of the SBA lending program, could be eligible. So we did have clients that, you know, we certainly talked to and helped with this tax credit. What it is going back to March 12th of 2020, the CARES Act said that based on eligibility tests, the taxpayer would be able to claim a tax credit against the employer's share of the Social Security taxes. So that's the 6.2%. Both the employer and employee both pay that percentage on wages. But this is the credit against the employer's share of the Social Security taxes. So there's two code sections that the bill put into place. The first one, Section 206, and it doesn't change the computational rules for 2020. But what it does is it changes the eligibility rules. Now, if you were a borrower under the PPP program, you can absolutely take advantage of this employee retention credit. That's a big deal because companies then could borrow and get tax-free loan forgiveness and pay certain expenses, but they could also go back now and claim this very important tax credit. So we're going to talk about 2020 first, and then the changes in 2021. But I was thinking in explaining this, I'm going to kind of tee up a quick example here and show you how the credit changes from 2020 to 2021. So let's assume for a moment in 2020, you have an employee that makes $10,000 in the first quarter and then $10,000 in the second quarter. So for 2020, there is a cap on the amount of wages that can be included. So the cap was $10,000 and the credit was 50% of those $10,000. So in 2020, you could take a credit capped at $10,000. So 50% of $10,000 is a $5,000 tax credit for that employee. Now in 2021, the computational rules are tweaked. So this credit would be available for the first two quarters out to June 30th of 2021. But and we'll talk about it in a little more detail, but in a moment. But the same facts: one employee, quarter one, 10,000, quarter two, 10,000. We have $20,000 in total wages. You're allowed now to take 70% of $10,000 per quarter, not annual. So in 2021, instead of $5,000 of credit, you'd be getting 70% of $10,000 in the first quarter, $10,000 in the second quarter. So $14,000 of tax credit. And, you know, for companies that have a large amount of employees, this credit certainly does add up. So I want to go back and talk about the computational rules for 2020 for a moment. Now, the criteria is in order to be eligible for the retention credit. It's not available for everybody. Number one, first test, you have to demonstrate if your business was either partially or fully closed because of government requirements. So if you were a restaurant and the governor of New Jersey says you can't have indoor dining, that's at the very least a partial closure. Retail stores, manufacturing, if you weren't allowed by government authority to open your doors and you have a partial or full reduction, shutdown, that's the first step. You would qualify. For each quarter that you're partially shut down or fully shut down, you would be eligible for the credit. Secondly, if you demonstrated that in your quarters in 2020, starting with March 12th, that you had a more than 50% reduction in your gross receipts, look into the comparative quarter in 2019. Now, my perspective going back to the partial or full shutdown, you know, if you're fully closed by government authority, the governor says you can't open your doors, that's a full, that one is easy. But certain situations, and I think that's where, you know, good tax advice comes in, you know, we have to really control our facts and circumstances. Bob, we were talking about this issue yesterday. You know, there are examples, say an accounting firm has their employees, they're not told they specifically have to shut, but for safety purposes, they voluntarily have people work from home. That likely would not qualify in that example. You're a retail store and the governor says you can't have anybody come in, that would likely, you know, qualify as a shutdown. So in 2020, now that if you were a PPP borrower and now you have the opportunity to go back and claim this tax credit, this is I think going to create either opportunities to amend payroll tax returns that have been filed, or possibly claim advanced credits again against the Social Security taxes. I just wanted to add computational for 2020. If you had less than 100 employees, then any wages that are paid could qualify for the credit as long as you met the two tests. But if you have more than 100 employees, this is where it gets a little tricky. So larger employers with more than 100 employees, you have to actually be paying these employees not to provide services. So if they're working for you and you're paying them and you have 300 employees, you can't qualify those wages for purposes of the credit. You have to be paying them, and that's why it's called an employee retention credit. You're basically paying them to provide no services. You're a restaurant and you can't have indoor dining, and you pay the waitresses and the waiters and you pay the bartenders to basically stay home, and you retain them, credit eligible if you have more than 100 employees. So the change for 2000, and I just wanted to, before we talk about 2021, there was a tweak to the rules for what constitutes wages. So previously you had to have W-2 wages and you could include health benefits. Now the act says that even if you furloughed employees and you weren't paying W-2 wages, you can count the contributions, the employer's share of health insurance. Now, important distinction, you'll see in the slide in front of you, you can't use the same wages, so you can't double dip, as they say sometimes in taxes. So you can't use the same wages, and the priority is to the retention credit. So if you're claiming the retention credit, you can't qualify those same wages for loan forgiveness. But you can elect out, and you can elect to not take the credit up to the amount of the loan forgiveness. So let's give an example. Let's say my business, I borrow $100,000 of PPP money, and I know that that $100,000 is going to qualify for forgiveness because I have $300,000 of eligible payroll expenses. So my eligible payroll is greater than the loan amount. And then I look, my tax advisor says, Ed, you have $50,000 of wages that would be eligible for this tax credit. So I'm only precluded, the way I read the act, that the $100,000 that qualifies for loan forgiveness, that comes out of the bucket that you can take the retention credit on. But the remainder, I said you have $300,000 of payroll. That other $200,000, I said in my example that $50,000 of those wages would be eligible for the credit. So you can do both, but you can't get forgiveness if you're claiming the credit on those same wages. So. And we're going to talk a little bit later about in our next steps of how, in our PPP assistance and how these two tax benefits combine. Let's switch gears. Let's talk about 2021 for a moment. So we have, for the first 2 quarters, the bill extends the retention credit out to June 30th of 2021. So we have 2 quarters. So what are the key changes from 2020? Well, I said earlier, I gave an example. You're looking at $10,000 per quarter, not annual. So per quarter, $10,000 cap. The credit rate goes from 50% of qualified wages up to 70%. So my example earlier, I said for 2020, 10,000 for one employee, 10,000 in Q1, 10,000 in Q2, you're capped at a $5,000 credit. In 2021, under those same facts, you get a $14,000 tax credit. Also, I said earlier that you would have to show a decline in gross receipts by 50%. Well, starting in 2021, you have to show a decline in gross receipts of more than 20%. So you have to have less than 80% of gross receipts, and you do that on a quarterly basis, looking back to 2019 for the comparative quarter. Now, if you weren't in existence in 2019, you're comparing it to 2019 because when you think about it, your gross receipts would likely be much higher in 19 than they were in 20 because of the COVID crisis. So in 2021, you're looking back to 19, so it's easier to meet that decline in revenue test. Somebody asked, Ed, what happens if I am not in business in 19? Well, you're going to look to the comparative quarter in 2020. And also you can elect to look to the previous quarter. So first quarter 2021, you can look back to the fourth quarter of 2020 and then compare that to the prior year. So that gross revenue test. So I think there's enhancements to the credit in 2021. Bob, did you want to mention about the PPP program that we're doing, or do you want to save that for a little bit?
Talk about it later. Let's get into polling question number 5.
Excellent.
Okay, so this question leads us in where Robin's going to talk to us about the extension of the paid leave credits act.
Actually, Ed is going to, but I wanted to add one thing on the prior area where Ed spoke about that they added the health care. And the reason that they did that is because during this pandemic crisis, so many of us furloughed our employees. So there are instances where we didn't pay W-2 regular payroll, but we continue to pay the health care for our employees. A lot of companies did that. And so this act took that into consideration and made that modification. And then I'll let you jump back in.
Okay, the paid family leave credit came out of the Family CARES Act. This was prior to the CARES Act, and it mandated certain paid sick leave if an employee, God forbid, had the COVID or had to self-quarantine. Then there was mandatory for, I believe, less than 500. There was a 500 employee threshold, but there was a mandate to provide sick pay coverage, or let's say a parent, their child's school was closed, or they had to deal with a family member that had to self-quarantine or got sick with COVID, that there would be certain family leave pay. This is voluntary, so that expired at the end of the year. So in the new COVID relief bill, there's an extension of this tax credit. And again, this is against the employment taxes. So for voluntary paid sick leave, this is going to extend through March 31st. Paid sick leave goes up to 80 hours, basically 2 weeks. And I think there's a $500 per day or $5,000 cap on that. And then there's 10 weeks of paid family leave, and I believe it's a capped at $2,000. But this credit came up here and there not too much, but here and there since we started dealing with the CARES Act, but it is extended. And the second point, as you may recall, the president issued a memorandum that with respect to the employee, not the employer share, but the employee's portion of the Social Security tax withholding. So again, that's the 6.2%. So for that fourth quarter of 2020, to get additional cash in the employee's paycheck, so between September 1st and the end of the year, the employer could suspend withholding the Social Security taxes. Now, people ask, does that mean it's being waived? Absolutely not, it's being waived. It was just a deferral of payment. So that is actually going to be extended. That was originally going to be due, I believe, in April, at the end of April. It would have to have been paid back. So that means if you're an employee for a company and your employer was withholding, stopped withholding the employee's share of the Social Security taxes, they'd have to almost like double up. So you'd have more, you're just kind of kicking, as they say, kicking the can, down the road somewhat. So there is a deferral on that. Robbin, did you have any thoughts? Did you deal much with the family leave?
Ed, not too many of my clients took advantage of this because they were worried about being taken advantage of. Everybody was very concerned about these penalties, and I'm the co-leader of our national tax controversy practice, so I'll jump back to what Bob said earlier about retaining all your substantiation that's required. So even if you have the simplified thing, very important. And similarly with this thing, it's if I didn't withhold these taxes from my employee, while they were saying they wouldn't treat them as trust funds immediately because I didn't withhold them, I had the obligation to later collect these monies from this person. Now, what if the person leaves my employ and they don't come back? Then what do I do? And I still have that obligation to pay it, or I'm going to incur penalties. So nobody quite had a great handle on how that was going to play out in my clients. And I when I say my clients, I'm talking about Prager Metis, our clients, really didn't take advantage of this very much.
Robbin, can you bring us up on the changes to meals?
Sure. There are a lot of other modifications in this act. As you know, we talk so much about PPP and EIDL and all of these tax credit programs and relief things, but there were tons of other provisions in the CARES Act and now in this EAA 2021, and including things that were mentioned earlier, changes to Section 163J, how we're carrying back net operating losses. If anybody has a farm out there, you can now elect to just do 2 years back instead of 5, but that's with the new act. But there were lots of different changes. Now along comes the Consolidated Appropriations Act, and it's giving us back our meals. Those of us who remember that we used to take 100% deduction for our meals. Now it's not for all meals. This is business meals. Have gone from 50 up to the 100%, but only for food and beverages provided by restaurants. So it must be a restaurant. And this is for all of 2021 and 2022. Now, I hope that this will be permanently extended. I've been a proponent of that for a long time. Our company and my partner have strong feelings on this. This is a well-substantiated deduction, and it's one of those things available to our smallest business owners. We're not advertising at the Super Bowl per se. We don't have budgets for those things, but we take people out to lunch and we do these things, and it is in the ordinary course of business. So I hope that one will be here to stay. The Act includes many other additional tax breaks, extensions, provisions, things that were completely squashed and done away with. I listed a few of them here. It's permanently, I listed this first one because it's one of the permanent things, permanently extended the excise tax breaks for breweries and distillers and such. It's similar to the 7.5% medical for individuals. That's a permanent provision. And then there were a lot of things that got extended out for 5 years. There's a couple dozen. The new markets tax credit and the work opportunity tax credit are among them. It then gave a lot of extensions of 1 or 2 years to certain energy incentives, such as the 1-year extension for the production tax credit for wind and other renewable energies. It made a permanent extension to Section 179D for energy efficient commercial buildings. But like I said, there's a long list of these different tax extenders that have come about. And then we also have lots of other provisions. And some of them are interesting in how this act has been set forth. I guess we've learned a lot. Ed alluded to that there were lots of ambiguities in the initial law. There were tons of articles. We had more questions unanswered than answered. And every time one thing got resolved, 3 more things popped up. And we said, but what about this? What about that? You know, so there were a lot of things. So this act cleared up a number of those things for us. It addressed like the basis issues and tax attributes and things like that. And then it also is giving significant aid to very specific pandemic impacted industries. So it's doing special things for airlines. It's doing special things for people in the events and industries like that. There are a lot of things out there for healthcare industries, for teachers, for all kinds of things. So they're focusing in on who's really been most impacted, like our restaurants and such. And then and so they've done the specific targeting. And then they've provided a lot of money that's specifically earmarked. So there's 25 million for this, 45 billion, for that. And so they've got a lot of this money is very specific for key areas. And then another thing that it did is, like I said, all these other changes, and I listed a few of them here that I thought may be of interest to some of our individuals and people who don't have businesses, because we've been mostly focusing on businesses, but we've all been hurt. And sort of like Bob started talking about the stimulus payments coming, and there's going to be another round, and maybe there will be a third, we'll see. There's an earned income credit that some people who are at the lower earnings qualify for. And now in 2020, they may not have these earnings, and they've given a special provision that will permit them to base their 2020 earned income credit on their 2019 earned income. Education expenses, teachers have a credit that they can take that's above, you know, an above the line credit of a few $100s. And they weren't allowed, like maybe you're a teacher and you're not just buying pencils and pads, now you're buying lots of hand cleaner and things like that to keep your classroom safe for the children and yourself. You're allowed to take protective equipment, will be included in that. There are education tax breaks. This is one where they got rid of something. The tuition and fees deduction that was an above the line deduction, that's now gone. But instead of that, they've increased the phase out limits for the lifetime learning credit. They're going to be geared to match up with the opportunity tax credit. So that's a nice change that will help people. And there's an exclusion for certain employer payments for student loans for 5 years. That's another big one. There's an amount that your employer is allowed to make regular payments on for that. So there's lots of different things. And there's other things outside this new act. You know, the SBA back in June they offered paying 6 months of your payments towards your 7A, 504, and certain microloans and things like that. So I would strongly recommend anybody that is really suffering from this pandemic, whether it's with a business or for you as an individual, that you really do reach out to your tax advisor. Don't want to steal your thunder next, Bob. Bob's going to talk more about what we should do next, but I would highly encourage that because there's a lot of different things that are available that we can't cover today.
So the poll is open, and the big question of the day is, do you plan on applying for a second PPP loan? I think that this is really very important because we have to first make sure that people qualify to be able to get the second PPP loan. And let's wait till the poll is closed, but we'll give a little guidance. Okay, the poll is closed. So, you know, if you would like to apply for a PPP loan, first or second, please contact your PM advisor or our crisis management team. It's very important that, you know, if a business needs the money, as we've said numerous times on this webinar, the client should definitely go and get the money. And we are concerned that if you don't get it soon, it may not be there by March 31st. So I think everybody should be focusing on applying for the next second round. So what's next? What's next is we make sure you're only spending PPP loan funds on covered expenses and at least 60% on payroll costs. We have to determine the length of your covered period, be it 8 weeks or 24 weeks, or be it the new loans that are the second round. During your covered period, monitor your wage and FTE comparisons. If you have FTE or wage reductions, restore them before the end of the period. Determine whether you'd like to voluntarily offer paid sick and/or paid family leave. And consider whether to take the employee retention tax credit, given the increased threshold. In regards to the employee retention tax credit, the software that we've had written for our firm and for our clients for the PPP forgiveness is currently being modified, and we'll have the ability to prepare a attribution schedule so that the client can make sure that if they are going to apply for employee retention tax credit for 2020, which would require amending prior filed quarterly 941s, and this credit would be applied for on a 941X, that the amounts that they're applying for are correct and that they do not have any issues with the PPP forgiveness payroll amounts that they have used. So this is something that we will make available to our clients. It'll be above and beyond the forgiveness calculations, but it will be available since some of the software some of the numbers we already have from the payroll, but we have to update pretty much everybody's payroll through 12/31/2020 to be able to calculate it, and also make sure that their business was affected and ultimately shut down. What else? There's research if the EIDLs or the EIDL grants may be the right fit for your organization. Now that the threshold is increased, consider taking the employee retention tax credit and determine whether you'd like to voluntarily offer paid sick and/or family leave. And if you do, you probably need to modify your employee benefits manual to reflect the changes that you would be offering. I'd like to take this opportunity to thank Ed and Robbin for assisting in putting this program together today. It was definitely a crash course. The bill, we didn't want to start working on anything unless it was signed. And of course, we all know it wasn't signed till December 27th. So during our vacations or holiday period, a lot of time has gone into phone calls between the three of us. And we really want to thank Sarah Doctor and our education, our university team of Peter Nichols and Sarah for assisting us in completing this program today. Again, let me remind you that the program will be available to everybody. The slides will be available. You'll be able to listen to the program if you missed part of it. And for anybody needing CPE, you'll need to complete an evaluation form that'll be sent to you, as well as a attendance form. Anybody, again, having any questions on any of the subject matter, put them in the questions area, not the chat. And in the next couple of days, the three of us will be working to try to answer as many of those questions as possible. Everybody, thank you for participating.
I want to add one thing, Bob, because I realized we didn't mention EIDLs right now. You could log in. It's up and running for the EIDLs. And one other thought that popped in my head when you were running through what next, one of the things next to consider is how does all of this affect you for the states? States are very different from federal, and a lot of these provisions, a lot of the states decouple. They don't roll along with it, and you can be impacted very, very differently in your results for how all of these things will affect you. So you'll definitely want to speak to your advisor on those issues as well. Sorry.
We had a very large attendance today, and I appreciate everybody's time. And hopefully we've given you at least enough information to make us all a little bit dangerous, but I think we need to take specific areas and make sure that they apply and that we're providing the right service to our clients. Thank you.
Thank you.